Hello everyone, this is Vipin Khandelwal, and today we are almost at the first episode of Knowledge with Unovest. And I have with me Arvind Chari. Arvind is someone I have known for many years. It's just a strange thing that we are actually speaking today after also many years. But let me introduce Arvind for more formal way. Arvind has over 2 decades of experience in investment management in Indian capital markets across macro, credit, and fixed income portfolio management. He has helped multi asset exposures by helping launch the gold ETF, equity fund of funds, and a multi asset fund at Quantum. And when I refer to Quantum, it's Quantum Asset Advisors Private Limited in India. Arvind is currently the CIO at Q India UK, which is the affiliate of Quantum Advisors Private Limited, where he guides global investors on the India asset allocation. So, Arvind, that sort of brings us to the very first question I would like to ask to you. What are you telling
Yeah.
your investors?
Thanks, Vipin. It's so good to speak to you and speak to your clients. I remember we used to do those written interviews, and we did a few podcasts as well. And I hope your clients benefited from that, and hope they'll benefit from this as well. Just to clarify one thing,
Just
I
want to tell you
used to
that
be a mutual
you know
fund
you
till
were
about
probably the first
2013.
one.
So
You were probably the first one way back in 2018 to tell me that why don't we do a video instead of doing a written interview. And I think that just
correct. Yes.
that I'm doing the first one with you.
Really? Okay. Yeah, good. No, I just wanted to clarify one thing. Till 2013, so between 2004 and 2013, I was with Quantum Mutual Fund. That's where I launched the liquid fund and the eventually the dynamic bond fund and all the gold ETF, the multi-asset, the equity fund of funds, along with my colleague Chirag. So, and then in 2013, I moved back to the parent, which is Quantum Advisors. And now, as you said, I'm the CIO at Q India UK. I moved to London 2 years back with family. It's been a very good move up until now. So yeah, so what do I tell investors, right? So if you look at Vipin, we think India is big. So India is almost 3.5, 4% of global GDP. It is almost 4% of what we call global market cap, right? But if I look at allocations by investors, by global investors, most of them have less than 1% invested in India. And even that, it comes from their investments in a global emerging market fund. So they are allocated as in a emerging market fund, and that emerging market fund has India exposure, or so that's how they have India exposure. Very few have what we call direct India exposure, where they've taken. I like the India story. I think it's a great place to be, and I want to invest directly. Now they can choose any asset class. It could be public equities, it could be private equity, it could be some will do ventures, more quite a few will do infra and real estate. I'm talking about the large institution like pensions, sovereign wealth funds, some central banks, insurance companies. These are the university endowment. These are all large institutions. But despite that, we don't see a large direct allocation, right? So just to give you numbers, the global wealth, like global AUM, is somewhere around 300 trillion US dollars. Huge amount of money, right? I mean, that includes pension funds, which are about 60 trillion, sovereign wealth funds, which are about 10, 12, 13 trillion, insurance companies, which are about 40 trillion, and then asset management, global investors, retail investors' money, and HNI money invested in asset management companies or mutual funds, that is about whatever 140, trillion. So that's the amount of global wealth. And if I look at the total investments in India, if I look at just market value, right, as of let's take December 2024 market value, the total market value of all foreign investments in India was about $1 trillion, slightly less than that. But if I look at public equity and debt, it's about $1 trillion. You add private equity, venture, infra, and real estate, उसका market value मिलने का, that it's a bit difficult because they are not as market valued as public equities are. Take another trillion of market value. So about 2 trillion of foreign capital is invested as compared to the overall AUM of 300 trillion, right? So it's less than half a percent, or just slightly more than half a percent. Whereas if India's weight in global GDP is about 4 5%.
Yeah.
So even if you say, okay, all the 300 trillion is not available for foreign investors, not everybody has home bias, right? Like as an Indian, you will want 70, 80, 90% of your money to be invested in India. That's just the home bias of institutions and individuals. That is similar in the global world. So say we say two-thirds is not available, one-third is available. One-third of that 300 trillion is 100 trillion.
Mm-hmm.
5% of that is $5 trillion, right?
Mm-hmm.
We are nowhere there as well.
So
Because,
that's the
and the
size of
reason I
the.
say 5%,
Hmm.
the reason I said 5% is India's weight in global GDP is 5%. And India is a beautiful long term story where GDP growth gets reflected in market returns. I can send you a chart on that. We've used it very often on our websites and our articles, that the Indian GDP growth grows at about 6.5% in real terms. Nominal GDP grows at about 10, 11, 12%. If the economy is growing at that level, then the corporates, like say the listed entities, all the listed corporate, they are the best companies, well run, best brands, best businesses, they are the ones who are the top, say top 1000 2000 companies in India. They will technically grow at a faster pace than the macro. So if economy is growing at 10, 11, 12%, they should be able to grow at 12, 13, 14% revenues. And if revenues equals profits and profits equals EPS, the share, their profitability should be growing at about 12, 13, 14%, given on an average. And if you look at stock prices returns, if you've been covering markets for a long time. If you look at long-term equity returns, tends to be between 15 and 17% INR terms, right? On a peak basis. When there is a trough, if you see a rolling returns, it will be between say 13 and 15%. But that's the kind of range. So in India, you can actually make a very clear, simple link that if GDP growth grows at 6%, your expected returns from equities should be anywhere between 12, 13, 14%, right? So that's why we introduced that same thing, that in India, if India's weight in global GDP is 5%, and India has this beautiful link between GDP growth and equity market returns, you should be able to think of allocating at least 4 5% in India, right? Because in India, economic activity gets reflected in market returns. It is public equities. It can also be somewhere in private equity. So this is my main role, Vipin. This is most of my meetings I do with this approach, saying that think about India, think about that how much you want to invest in India, and think about if India in a dedicated manner. India is very different in a, like if you look at emerging markets, you're like China, Brazil, South Africa, Saudi Arabia also is part of the emerging market index. It's very varied kind of countries that are there. Like Russia used to be part of an emerging market. Turkey is the most volatile part of the emerging market index. But if you look at India's returns, long-term equity market returns, and this link with GDP and equity market, no other country has that. Very, very. I can send you charts on that as well. We've compared China, where the GDP goes like this and equity market returns are like this. Brazil, same. But in India, it's a reasonably close link. So we are trying to tell investors that you need to think of India dedicated. India is big. India has delivered. If you look at you know last 20 years, 40 years, equity market returns, public equities, it has been in double digit in dollar terms as well. Forget about INR terms. Even in dollar terms, India has given double digit dollar terms. So that's the way to think about India, and that's most of my discussions with them is to think and then guide them, saying that okay, if you eventually want to do 2 3 4% in India, what kind of risks are you taking on? It's not a one-way street, right? There is a lot of risk that in India that you take up, like infra and real estate. If you have a team in India, if you think you can manage the governance aspect of it, then great, it's a great asset class. But if you're sitting somewhere in New York or in Chicago and you're trying to do that through a manager whom you don't know whether they're good or not, that there it can be very damaging to your returns and reputation. So what to take risks, how do you think about it? And then we narrow it down at least in our, which is saying that public equities is the best option for you to play, irrespective of what you think about valuations and all those things. But a long-term dedicated allocation to public equities needs to be made by these investors. And then in that, then we talk about how we at quantum, the quantum long-term equity value, or what we call the Q India value equity strategy for foreign investors. Uh, we use our thresholds of a liquidity filter, a very clear governance screen. There are companies that we will never invest, irrespective of how big they are, how large they are. We'll just stay away from them. And a valuation metric. When you invest in India, our job is to manage that risk. So it could be a liquidity risk, it could be governance risk. Liquidity, when we also say, like a lot of people get enamored by mid and small cap, and they've done well, but the amount of capital that they can deploy and take back and have a predictable NAV is very different, right? So large investors cannot allocate as much capital to say a mid and small cap strategy. So that's why we use the liquidity filter. And then this valuation govern discipline that we have, that we want a discount to intrinsic value. And when we reach intrinsic value, we'll kind of trim and sell. So we basically feel that everybody should have a fundamental allocation to us. And then they can take risk. So they can take a risk with a growth manager, with small cap, with private equity. But this is broadly what we say. Look at India, think about a high allocation, think about dedicated India, think about public equities, and think about quantum. That's the way I'll frame it.
Okay, okay. So I picked up that one line from what you said, that in India there has been this coinciding relationship between GDP and sort of the market
Yeah.
returns.
Yeah.
And you're saying that this is quite unique to India in that sense. I'm asking, maybe I'm questioning, what if this link breaks in the future?
Yeah, so we get this question as to why this is in India and what if this link breaks. And I'll give you a like, I think there are four things that drive India in that sense. One, the first two are democracy and rule of law, which some other countries might not have, or even they have a very authoritarian regime, or there are different things. In India, because you have democracy and rule of law, people have property rights, people have rights of property, people have rights of business, people are free to do what they want to do. And India is essentially a micro story, right? People talk. I gave you the macro reason of investing in India, but essentially the entire Indian story is a micro story of individuals, entrepreneurs like you, and their aspirations and what they want to do. And they will thrive and survive and have problems irrespective of the system. And we find a way and we do it, right? And that is true for everybody. Like, people are aspirational, and you can see that right for the last 30, 40 years, where we've seen people's aspirations change and they've evolved, and we have a long way to go. But that micro story. And then if you look at Indian corporates, given their history of what they have felt from the government, and in terms of what they can do, what they cannot, they are very good in converting this broad growth to their own revenues and profitability, and are very capital conscious. So the concepts of cost of capital, return on equity, cash flow, it's ingrained in many Indian businesses. And that shows off in terms of either in a private business or Indian business. You'll always see return on capital ratios should be higher. I think these combine to go there. The risk that you said is the reason we believe it has not worked in many other emerging market countries is again the same thing: democracy and authoritarianism and crony capitalism, for example. Right? So in Russia, the GDP growth happens, but it is concentrated with a few oligarchs, for example. So you see GDP growth, but that growth is not getting transported either to the people or to private corporates and private individuals. Same with China. The state is such a heavy hand, and the state can decide who will get to business and who will not. The state can decide who can make money, who cannot, right? And as investors, Manmohan Singh made a beautiful comment in 1991 after the July 1991 budget, and he said that investment is an act of faith. Right? He was basically telling to private corporates and foreign corporates, saying, invest in India as an act of faith, that we have to ensure that we always keep that faith. And private businesses are all always like that, right? You when you do something, you need that trust to be able to invest. When you don't have that trust, or when you feel that if I invest, there is a possibility that a crony capitalist within the government can steal my business or can steal my assets, there is a limited amount of, how much risk you're willing to take with those kind of situations. I think if we get into those kind of situations in India, we will have a problem. Which is also why, Vipin, we've always said that in India, coalition governments are the best outcomes. Because in a coalition government, there are always checks and balances, pulls and pressures, and aspects of you know centralized control becoming lesser, right? So India has, barring the previous two terms under BJP, even this government is like, this is now a proper, what we call an NDA government. It's no longer called a Modi government. Because India is so diverse and India has so many different aspects, coalition governments helps, and I think we believe that coalition governments keeps checks and balances in place at some point in time. So that's the risk. So you don't want to get into a risk where, like other countries, where few people or few companies or few individuals or few oligarchs or few government officials benefit, and that breaks the link. Otherwise, I think in India, given our democracy, our very diverse basis, federal government, state government, municipal government, so we have those structures in place, right? Which is why I think I don't think it should break in India.
Okay, so sort of what you're trying to say is that even in near future, let's say next 10, 20, 30 years, if we are able to grow at our GDP at about 6.5%, we
Correct.
should see on a broad market basis returns of about 13, 15, 16%. That's reasonably likely to happen.
Correct. That's, I mean, it's not a guarantee, but that's the way you think about, frame your expected risk and return. And that is a good rate of return, right? 6% GDP growth is double of world GDP from a global perspective as well. It is not enough for India to grow at the pace at which it should be growing. But having this estimate, having this expectation, makes it better to look at returns. I'll tell you an example. You remember the BRIC period, right? India was part of BRIC, Brazil, Russia, India, China. Goldman Sachs coined it. And in that period, people expected India's birth rate to be growing at 9%. Right? India will always grow. Like you had people, policy, government people were saying that India will grow at 8-9%. So when you expect to grow at 8-9%, then you build the same, like 8% real GDP growth, 5%, 6% inflation, so 14% nominal GDP growth, add 2-3% for corporate revenue. So your public equity, large cap, liquid expectation went to 17-18%. And then you expect more from small cap, private equity, venture. Look at the risk that you are taking with because of the expectation moving, right? And you know how that played out. Uh, at that time, especially in small caps, you had a lot of foreign money into small caps and private equity and real estate. Indian retail were not as exposed. You know that story, right? Our major increase has happened since 2014. So we didn't feel the impact of a socio-political impact of a big market crack because of the expectations going wrong. Because the GDP growth came back to 6.5% very quickly. Right, there was some spike, and 2011 we peaked. We haven't actually gone back to that 2011 growth cycle. I I, I just shared that document with you yesterday. What I wrote about
I hope there's no
GDP
statistics
growth
involved.
over.
Right? This is all comparable. When we say
Correct.
2000
Yeah.
now, right? There's no
Correct.
statistics.
It is comparable because, yeah, things have changed, trends have evolved, but still, gross domestic savings is gross domestic savings. Real GDP growth is real GDP growth, right? The way you think. So having this six and a half, 10%, 11% nominal, and this 13 to that range of equity market expectation growth will help you invest properly, will help you invest calibrate, saying that, okay, this is what I can achieve. If I want more, I have to take more risk. So what is that risk that I need to take? But this is what India has delivered, irrespective of whichever government is in power, single party, coalition, left government, right government, whether global rates have been higher, whether global rates have been lower, whether there have been wars, whether there have been famines. You've seen everything in the last 45 years since 1980, right? And this is your average growth, and this is your average return in equity market. That's the way to frame your basis of what you can think and what you can achieve and how you can plan your investments.
Right. Okay. What's the status today for India as the economy?
Can you
Are
repeat? Your voice just broke.
are we slowing down? Are we India is slowing down, or there is not much of a problem? It's everything is temporary for now.
I'll just go back to the same framing, right? If you expected India to grow at 7% plus GDP growth, then of course this is a slowdown. It's a structural slowdown because we've not had average 7% growth for 10 12 years now. Our average last 10-year average also is about closer to about 6% real GDP growth. Of course, there's a COVID period, so that took away some of the return, but it is still between 6 6.5. So if you're thinking about slowdown, yes, we are slowing down. The numbers below 6% last quarter is slowed down, and then we've slowed down over the last 1 year. But it is not. If I look back in 2016 to 20 pre-COVID period, also we had similar aspects of going up and then slowing down. So there are some structural reasons, and I said democracy is a good aspect. Democracy could also be a constraint, right? In terms of what we can do and what some other country can do, but we have to live with that constraint. So of course India is slowing down, but like I don't believe, if because my expectation is that India will grow at 6 6.5, I will believe this as a cyclical slowdown. And there are like fiscal, like look at all the Ladli Behna and Ladli, whatever schemes have been announced by all state governments, right? Well, BJP,
Mm.
Congress, non-BJP, non-Congress, everybody has gone and announced either a direct transfer scheme, and they've chosen to do it for women because it's a good vote base, and it's also and because you can do direct transfers. That's a significant fiscal impulse. There was a calculation that it's almost like 2 trillion, 2 lakh crore, 2 lakh crores, 2 trillion rupees of new spend is going to go direct into people's account. So that is a fiscal lever. And people can call it khatakat, people can call it revdi, the politicians will call it, but they are the first ones to react to it. They are closest to the people. They know the underlying reality. And the underlying reality, Vipin, is that India is not at that 6 6.5% growth. India is not creating enough jobs of wage. Nobody can remain unemployed. It's just too difficult to remain unemployed in India. But a job for your education, for your work, at the wage level is not able to grow at that level. And politicians have realized that it is that you need social stability. You have to ensure that certain amount of money is going to social stability. So otherwise people will revolt and riot, or they will lose the elections. So we at Quantum, we've always seen the government spend in rural, and this is a necessary spend to ensure that people have incomes and consumption and sentiment. And maybe they'll have to ensure that capital expenditure comes from better policies. So that's one aspect. If you look at RBI also, we've maintained for the last 6 7 months that they've actually kept monetary policy, as we call, too tight, where liquidity is too tight and rates are slightly higher. And so they have levers. You would have seen the last week announcement where they have announced they allowed the rupee to depreciate. They were actually holding the rupee very very tight. In fact, for a point, the Indian rupee was less volatile than the Hong Kong dollar. And within Hong
Mhm.
Kong dollar is a peg. It's a pegged currency.
Mm.
So in India, it was so less volatile, and it doesn't make sense for a country like India, which is dependent on goods import, current account deficit. We are dependent on foreign capital. You have to allow the rupee to. So they have allowed the rupee to float. I think the rupee will depreciate a bit more, yeah, eventually. But which means they will focus on maybe cutting rates. You should see. I would expect a rate cut to come through, and they've added liquidity. So these immediate steps should have some impact, some slowdown, like it'll arrest the cyclical slowdown. Whether India goes back to 7% growth, I think that still requires a big factor. For that is investment in exports, right? If you see the previous cycles, 1990s and the 2000 mid 2000, it was exports and then domestic investments to cater to that exports initially, and then exports drive domestic demand. Those were the high points, right? That's where the money went, and we still don't see a large exports of goods. Export services has done very very well, but exports of goods haven't picked up. And we haven't seen what we call this private capex, right? Companies investing in fresh capacities to either cater to export demand or for domestic demand, which tells us that the domestic demand is still weak or capacities are in excess. So companies are still deleveraging or raising capital because equity markets are attractive, but not reinvesting it, maybe using it for to pay off debt. So once we get into that cycle, maybe we'll see an increase. But otherwise, I think we'll middle around this 5.5 to 6.5% real GDP growth.
Okay. So let me tie around, what you have said,
Yeah,
and take some questions that my clients or readers have asked.
yeah,
Number
absolutely. Yeah,
one, this currency depreciation thing, right? People have been,
yeah.
it's just a perception thing, but they've been really upset, that the currency is depreciated so much. People who are planning to send the kids to, universities outside suddenly have to shell out a lot more. And I don't know. I mean, my limited knowledge, I think, is of course, and as you said, it's going to depreciate more. How much more is it going to happen? And a related,
Like there's a technical answer to it, which is if I look at measures of currency valuation, which is we typically use something called real effective exchange rate. India is about 5 or 6% overvalued to that level. So this was, now we can debate why they kept it that way. Uh, uh, and I'm seeing average. This is not it's a long term average. Against a very long term average, India seems to be about 4 to 5% overvalued. So that could be one way to think about it. We generally believe that India will depreciate about 2 to 3%. You should assume against the US dollar, the Indian rupee will depreciate by 2.5 to 3%, 2 to 3% every year on an average. But that it will never be every year. It will be flat and then there will be a spike. Like we've always seen that. Like if you go back to the 90s, the rupee was 37 flat and then went to 44. Then it would remain between 40 and 46 in the during the brick period, and then from 2010 it went from 46 to 65, right? From then in 2014 to now, from 60 or it has come to 85. So there are flat periods and there is spike, but if you see the long term average, it tends to be about between 2 and 3%. So if for people who want to send their kids for foreign education or whatever, should budget for this against the dollar, other currencies, but generally against other currencies also, we tend to have somewhat similar averages, which is why we've always said that the one asset, because you can't buy, if you can buy foreign equities is good, but the one asset to hold for that is gold. Because that rupee depreciation risk that you get, some part of that gets comforted by gold. Now of course, what price you buy gold, when you buy gold matters, but in general, that gold tends to be it's a sign of stability. And we've always said, like, buy gold because you're worried about the stupidity of politicians, central bankers, government officials, right? It's a hedge against that stupidity of these set of people who rule us, who govern us. So that's a good asset to own. And for Indians, it also, because it's a dollar priced asset, so when the rupee depreciates, gold price and INR kind of increases. So it gives you some amount of, I'm not getting a sure short hedge, but so it gives you hedge against stupidity, and it gives you hedge against some amount of rupee depreciation. So that's a way to think. Of course, if you think you can do a mix of gold plus global equities, or global investments, subject to that whatever LA, investment offer. So that's the way to think of it. But assume at least a 2% depreciation of the dollar, of the rupee against the dollar.
So with that, I think the 100 mark on the USD INR should be a few years away.
Yeah, I mean, if you extrapolate it, and I, I don't think it should be a sign of weakness or strong strength. It is what it is, and
It is what
in
it is, yeah.
a open economy like India is a fairly open economy, right? The currency is a good barometer of macro stability. Like you can have macro adjustments through the currency route. So people make it into a political thing of that strong rupees means strong nation, or weak rupee means, it's not that. I mean, India will, if India's productivity, inflation, and inflow of capital is way more than what we need, the rupee will appreciate. Like the rupee could have appreciated in 2000 18 to 22, when we were getting a lot of foreign flows, and the RBI were actually buying the foreign flows to not allow the rupee to appreciate, right? So some amount of what they are doing right now is they bought when times were good. When times are not good and if outflows are happening, they are allowing the rupee to appreciate, or they are using the foreign. I think it's an adjustment mechanism. I don't think people should take this at heart in terms of the dollar value of the Indian currency. It's not doesn't that doesn't mean much.
Okay. Okay.
It means much from a, like, if for you to send people out in dollars, so it means monetary impact for it. Or when foreign investors are investing and rupee depreciates, they lose out on their eventual dollar return. So it means for that, but the number value has kind of no significance in some sense.
Yeah. So you also talked about this whole subsidy thing and direct transfers.
Yeah.
In some way, it also adds to the fiscal pressure, right? Now,
Yeah.
and this is a common thing. I'm sure you must feel it, and many others do. That this fiscal pressure, especially created through subsidies, is leading to increased amount of taxation. Is there a fair linkage there, or it doesn't?
I
And I
mean,
just want
see,
to understand whether it is actually the case, and if people are carrying sort of a misconception that because of these subsidies and revenues, there's more taxation happening, and it's impacting everyone.
not really. Yes and no. See, India is a poor country, and our policies of the last 30, 40 years have made it better than what we were in the 1980s and 1990s. But we are still not, as I said, not going fast enough to deal with the, like, we basically have a number that 25,000 Indians are joining the workforce every day. That's the amount of number of people who are joining. So you need to be able to create jobs for those people, and we are not growing fast enough. So if you don't do that, and if you're not going fast, then the state has to provide for certain aspects. Now it could be direct transfer, it could be cash, it could be free food, it could be subsidy on the gas. You have to do it till the time people's per capita income levels come to a level. Now, the way to think about this is, but the government has limited resources, right? And India, there is what we call a fiscal act. You can't go beyond a particular level of fiscal deficit, both at the center and the state, right? So if a large amount of your allocation goes through subsidies, interest, salaries that you pay, then the government has to decide, okay, I still need to invest, I still need to create roads, I still need to create infrastructure, I still need to create capacities. How do I do it? So there is a huge private sector sitting and wanting to participate in that, but at terms which will be beneficial to them. So the government will have to then decide, okay, I want to do this, but I've already done all my spending here, and I have to do this because this is social requirement. I only have this much left. How can I ensure that I get the best bang for a buck for this capital expenditure? Why? What kind of policies? I'm not saying incentives. It could also be policies that in 10 years back, NHAI was, people used to say they were the biggest defaulter. And a lot of private entities did annuity road projects and lost money. But it could be their estimates have gone wrong, but it could also be that the governance structure at NHI was not good enough to allow that returns to happen. So there is a fiscal constraint, but we need to do both. Can the government figure out good policies to ensure that there are more private sector doing some of the projects that it cannot do? So it's a mix. Uh, Taxation, it is high for, like, on a relative basis, at our income levels it is higher than other countries, both the GST and income tax. And people tend to make a misconception that income taxpayers are only the taxpayers. They are not. Every Indian who buys a product or a service pays tax because there is GST on it, right? So everybody is a taxpayer. Now you can argue that people are not disclosing, and that's a government compliance problem. It's not. And also, I always say that people say salaried income tax are honest. They are only honest because there's a TDS. You remove the TDS, and then you'll see the honesty of direct income tax salary payers, right? So let's not get into that aspect that he's not paying tax and I'm not paying tax and our farmers are not paying tax. That's a policy decision that has happened. But is there a scope to reduce taxation? Yes. I mean, like, look at fuel prices. I think the fuel prices are at least 7 8 rupees higher than what they should be, because the global prices are like that. So I don't know why the government has not enacted on. They did cut something, like even GST, or the overall GST, given the revenues that we're getting. Maybe there is a case for rationalizing GST, and in terms of how to simplify it, plus also reduce some amount of GST tax rates to ensure that there is a benefit for the, like, people's consumption costs go down. And we know that as taxes go down, if the economy activity is supposed to go up, the government will make up its taxes by more activity.
Exactly. Yeah.
There is a big scope for that. Of course, I think there should be a lot of direct tax reforms, and I think we've made it very complicated. Plus, today, from an investor perspective, because your dividends interest is taxed, dividends is taxed, dividend distribution is taxed, and then all your capital markets are taxed: STT, short-term capital gains, long-term capital gains, derivatives, futures. There is a significant amount of tax on capital, which is for professionals and salaried. It is after tax. So after tax money, you get taxed some more on your income. I don't know. The government has very clearly taken rule that they want to tax it. But given our long-term requirements of capital to be able to build what we want to build for the country, we you know I there are two ways to think about it.
Okay. Okay. I think the government is getting to decide that. The taxpayer is not going to
Yeah,
decide that.
yeah, it's a policy decision, that you have to live with that policy decision.
Okay. So, so tell me, based in today's scenario, how is your own portfolio asset allocation? How are you as Arvind Chari investing?
So it got a bit like changed because I had to move, and London is a very expensive place to stay, so I don't. There's not much of saving that I end up doing. But when I was in India, and I still follow that. I had a very simple allocation. I had three buckets that I had chose. One for me and my wife in terms of our wealth and our eventual retirement, or whatever corpus that you call. One was a retirement corpus, which was pension, and then one was my daughter's component, and I had kept it very simple. So in pension, I went as low as I could mandatorily on EPFO, and I did NPS, 75% equity, the rest was debt. So I chose that option, and that was from my employer.
This
So
is corporate
10%
MD.
of basic. Yeah, corporate NPS. I moved to corporate NPS whenever Quantum, my firm, moved to corporate NPS. So that was my retirement corpus. 75% equity, 25%. I like that exposure, very low cost. It works. There is computation, taxation, all those things, but I there is no other option. So I did that. Anyway, capital gains tax is there on equities any which ways now. For my personal portfolio, again, it was 75 80% equity, and 5 to 10% gold, and the rest was liquid bond fund. You know. And in equities, of that 75 80, about barring 5 10% of that 75 80, so say 60 65% was in three mutual funds. I didn't do stocks, and the rest 5 10% was to satisfy my own ego as being a fund manager and markets guy. I thought I can time better, and I can, so I should do whatever was allowed from a compliance perspective. I should do some sector allocations or sector funds, depending on what I think about valuations and stuff like that. But otherwise, I generally don't do SIP, but which is a problem because there's no discipline. I've generally been a lump sum allocator as compared to SIP allocator, uh, for my personal portfolio. For my daughter, it was 90%, 95% equity, 5% gold. Again, two equity funds, but hers was SIP. Every month I used to target. So I just tried. I thought this was simple. I think I don't know. You can tell me. You've seen many other portfolios. So I just found this to be a very good way to think about three buckets and how I want to put. So daughter was SIP, 95 equity, 5 5 gold. Retirement corpus was NPS 75 equity, and my corpus was 70-75% equity,
And you
and then
keep
the
this
rest was
allocation
debt equity.
constant?
Yeah, so like last year, when my equity went to above 80, I've trimmed. I've sold quite a bit of my, not quite a bit, like I got it to about 70% slowly, gradually over the
That's what you're
last
comfortable with,
years.
70% equity.
Correct. It's, I don't know, there's no math to it. It just
That's okay.
felt like it.
That's your personal
Yeah.
comfort. That's what I'm saying.
That's the way I just it in my mind it just becomes simple that I don't want to be more than 80% in equity. So when it started going that, I cut it. I also expected the GDP growth to slow down in my mind, so I said, okay, earnings will have an impact. So maybe I cut early. Then the market is correcting only now, so I may have missed some of the rally last year. But fair enough. So I got it to about 65 or something like that, 65, 70, and I will scale it up now. I think if you look at index might not have fallen much, but some other stocks seem to have fallen a lot. Although I still think many things still look expensive given the growth estimate. You have to estimate if the growth is going to be at 6.5, then what is the earnings growth, and what kind of compounding you're looking at. But yeah, so some maybe some sector allocation, some more allocation can be started.
Okay, so now also tell me this, that interest rates in general have reduced over the past few decades, right? There's like a
Yeah.
sort of secular trend there. Would you say that this is going to continue in the future, and we're going to be at like a 2%, 3%, 4% interest rate maybe 10, 15 years down the line, and never see a 7% again?
Globally, you're saying, or India?
India, I'm talking about India.
No, I think India, for a considerable period, you should assume Indian rates to be between 6 and 8%. Right. So if there is a macro problem, inflation goes up, you might go to 8. I'm saying about 10-year bond yield, or a mix of, or just look at FDs. Uh, the way I think about bonds in India is that whenever it goes towards 7.5 and above, I start buying duration, or I will start recommending elongated maturity. So if you're doing an FD, then start locking in slightly longer tenor FDs. This used to be 8.5, 9% 10 years back. I would start doing it at above 8. But now, India has inflation targeting, right? So India targets that 4 to 6% inflation. So if you look at Indian yields, so the 10-year bond yield used to trade between 4 and 9 between 2000 and 2014, and now trades between 6 and 8.
Hmm.
During, even during COVID, it went below 6 but didn't sustain that. It has not gone beyond 8, barring once in 2018. Even in this spike, when global rates went up, Indian rates did not go anywhere close to 8%. Forget about it. Anywhere close to 7.5 as well. So that's the band that I think. So if it goes above 7.5, 8, towards 8, I will increase. I'll buy dynamic bond fund, or I'll increase long maturity duration, or I'll increase my FD profile. If it goes towards 6, I'll reduce it. So that's the way to think about allocation to fixed income. But I think that 6 to 8 band will remain in India. We still have about 5% inflation, and globally, I don't think, because globally the only worry that I have is demographics has changed. Like, the world is becoming older, and all this immigration nonsense that every country has now, that they don't want immigrations, is going to have a big problem on this developed world, where they are running out of people, or they're getting older, and they're not allowing immigration to happen, right? So which means the employment, the labor market as we call it, will remain tight, which means inflation will remain slightly above average. So I don't think global rates will sustain back at 0%. Europe is different from a demographic perspective. Japan is different from a demographic perspective. But like if I look at US, where there is still, the average age is still low, but if they have an immigration problem, and they don't allow immigrants to come in, you should expect inflation to be relatively high. And then, So you are in this 2% to 4% band globally. So if you are 2% to 4% band globally, add 2-3% more to that for India. So you are in the even in the 5 to 7% repo rate band, which means you are at a 6 to 8% fixed deposit bond yields band, and that's the way to think about rates.
Okay. Okay. Are there any other risks you're foreseeing in this year at least? Or they, let me put it another way. Are there things that you would tell investors to not do in this year or say the next 6 months?
I think one thing I'm worried is how do Indians respond to a 20-30% drop in their portfolio value in equities, right? We've not seen this like the prior times when we've seen this 1990s, 1999s. We've seen people moving away from equities. 2008 after Lehman, so a lot of money went to ULIPs and mutual funds in 2005, 2008, and then Lehman happened, and then 2009, 10, 11, 12. I think 4 years of net outflows mutual funds had at a very low base. Like the number of investors itself was very low. Today, the number of investors is very high in mutual funds, direct equities, AIFs, PMS. There are the it's become very broad based. Uh, I don't. I want to know. I want to see how they react to a drop and then a weaker markets for say 6 months, 1 year. I don't know how politically, socially, or in terms of returns they will react, and that is something that I want to see. And if I look at data points, the allocation to mid and small cap or micro cap or SME seems to be very large as a proportion of the portfolio, especially in the last 2 years. And we know within over cycles how that corrects that and can correct and can remain in correction for a long time. I want to see how that is one risk that I don't know. We have not seen it. There is a large amount of allocations, and it's great to see Indians investing in equities. It's fantastic. This is a big win for Modi. Like that investment act of faith that I talked about Manmohan Singh. I think the more, and if you see the curve, it's exactly 2014. From 2014, you see a spike in equity mutual fund flows, SIPs, and it's just a confidence that people have to invest in their own company and take risk. So Indian retail has shown it. Indian corporates has not shown it yet in terms of capex, but Indian retail has definitely shown that, and it's fantastic to see, and it's a structural story. But I just want to see people who have over allocated. How do they respond? What do they do? What is the response, and whether how the regulators respond and how the politics respond if there is a very large correction, and we don't know how and when that happens. So that is one risk that I'll see, and I want to see. I don't have a sense of it. I hope, because generally from whatever falls you've seen, people have popped. Right? If we've seen every dip globally and in India, people have actually allocated, and it's worked very well for them. How whether this is different is the same thing, it's a dip, and people will allocate more, or have people allocated more than what they should have in expectation of past returns. And we can see those trend in say sector funds. There are so many sector fund NFOs that came last year, and I saw a table on Twitter, which somebody had put a table of all the NFO sector fund NFOs and their drawdowns, and it's all like everything is more than 10%, and a lot of money has gone into that. If you look at flows, sector funds had the largest allocation as compared to any other category of flows. So people have lost money, and I don't know how they'll respond to it.
So I think, as I am observing, people are not exiting really as of now.
Yes.
In the allocation that they've made to these so-called opportunistic, at the peak of the
Yeah.
market fund launches,
Yeah.
been minimal.
Yeah.
People are getting carried away. I think in some way also, but the portfolio that I see is not a significant part. So I think they're going to live with that. And
But I would think of you as a very rational. You know, you always been, I won't say conservative, but you've been sensible about
so, so,
allocating and
so I
recommending
I
allocation.
never make those allocations. It's the other portfolios that come to me. from
Correct. Okay.
they've been allocated outside, maybe
Yeah. Okay.
directly or through someone's advice. But yeah, there is a 10-15% allocation, not more, which I think these people are comfortable with. Yeah,
Correct.
the smaller guy who's jumped in the last 6 months, thinking that this is his road to kingdom. Yeah, I mean, that guy will be scared, very scared, very very scared now.
Right.
Yeah, but
Okay.
yeah, the investor is not going away. That's my sense.
Yeah.
But yep, they're going to be scared, especially a lot of new ones, because after 2020, if at all, this year could be the big year.
I think there was just in mutual funds, there was some 3 crore new investors since 2021 or from 2021, from CY 21. There are some 3 crore new investors just in mutual funds. I'm assuming there'll be a lot more in direct equities and
Yeah, I mean, of course, the trading accounts take the cake,
yeah, yeah.
and that's where the
Yeah,
real.
I think that is it's I don't know the pulse, but I think there is a risk that is something to be noted. Uh,
Okay, okay. So let me ask you a sort of a twister here. Let's say over the last 5 years or more, maybe, what have you
yeah.
changed your mind about in terms of your work, in terms of what you observed? Is there something you've changed your mind about? Yeah, you believe this was right, but no, it's not actually.
Wow, it's a tough one. In terms of my investments and work,
The way people behave, maybe.
no, I was genuinely surprised by the number of people who got interested in investing in equities. Like I didn't expect it to be so high, and it has been a significant. So, you know, whether that changed, I mean, it's changed the way we think about markets. For example, today, we used to say that the price and the value was determined. What the value of the asset was determined by the foreign investor in terms of how they price it. But today it's the retail investor or the Indian investor who drives the public equity markets. Uh, so that's been a significant change in terms of how we will think about investing and risk, and also like since I deal a lot more with foreign investors in terms of their outcome, but for them also it's a big comfort. See, look at the amount of exits that foreign investors have had at a very high valuation. And people say FIs are selling. FIs are not a homogeneous bunch, right? They are heterogeneous funds, but they are responding to market valuations. And maybe the RBI gave them a very good exit by keeping the rupee very stable. If the rupee would have
Hmm.
depreciated, they so if the rupee would have depreciated faster, they might not have sold as much. Or if mutual funds were also, for example, conscious of the valuation, and they would have maybe asked for a slightly more discount for that market price of from valuation perspective, or held cash, with things different things in terms of how they look at valuations. Maybe they would not have been able to sell as much as they've sold in the last 6 months, right? So it's a function of that. But for the foreign investors a big comfort that there's a huge retail investor base where the liquidity has gone up and they are able to enter and exit in a good manner. Has that changed? Yeah, of course, that's changed the way I will look at allocation, recommendation, investments. That's been a very, very big change. Uh,
Want to
Politically,
take it
like
hugely,
on
there's
the
always a benefit.
economically, I was expecting that once we've come out of the demonetization shock, we will eventually get into a situation where we will be able to grow faster. And the global environment was so much in our favor. China plus one. You think about everything that has to happen from a global geopolitics, everything was in favor, and we got some benefits of it. But have we taken the entire benefit? I don't. We still don't see that in numbers. Maybe it will come through. So that has been like a disappointment in terms of okay, should India should incomes and growth could have been a lot faster than what they're doing. But our base assumption has always been that it's difficult. Like it's better to have realistic expectation, and I think that has it just keeps getting reinstated every time, every cycle. We think, okay, has things changed? Should we increase our estimate? Will India grow faster? And just comes back to this level, saying that no, there are some things that might not change. So we'll have to
Hmm.
live with that. Yeah,
Great. Arvind, we have overshot by a huge
yeah,
margin.
by a big time.
So, but thank you so much for making out this time and sharing all the insights. Hopefully, we'll get in touch
So
again soon.
I hope your clients give an hour to listen to this.
Well, of course, I mean, I know that people at least who work with me, they are more conscious about understanding the way things are rather than just going out and making some allocation. I think it's going to give a very useful perspective, and I have benefited a lot from our today's discussion. Let's see how
Thank
it
you.
translates
Thank you
into
so
some
much.
real action or advice.
Love
We'll
talking
be
to
in
you.
touch and we'll see if we'll catch up again soon on this.
Sure.
Thank you. Take care. Bye bye.
Thank you.